Welcome to the True Wealth Podcast, where we specialize in helping aspiring homeowners break into the real estate market and help investors create and build wealth through real estate. We will be sharing some of our best advice around real estate so you can purchase your first home or reduce taxes and achieve financial freedom. Your host, Seun Adeyemi, is a certified financial planner, mortgage professional. Financial freedom is possible when you have the right mindset, coaching, advice, and community. So, let's get real.
Welcome to the True Wealth Podcast. I'm your host, Seun Adeyemi. Today, we're going to be talking about unlocking the secrets to appraisals, the value home appraisals bring into the whole real estate buying process. And today, I have Chris Bisson online. Chris runs a technology company that streamlines the whole appraisal process for all the parties involved, from the mortgage broker to the lender to the investor or the home buyer. He runs a firm that helps streamline that whole process. I'll let him talk a little bit more about it. Chris, how are you doing today?
Oh, Sean, I'm doing great. Thanks so much for getting my last name right. I don't know how you figure that out, but most people don't know how to pronounce that name in English. I'm really thrilled to be here because the appraisal process is one of the biggest pain points in the investor journey or the home buyer journey. And we're just thrilled to be here because our whole mandate is to streamline that process, create more transparency for everybody, and just make the whole process that much, I'll call it user-friendly and better for everybody. So yeah, I'm just thrilled to be here alongside you.
Thank you for joining us. Appraisals is one of those things, like you rightfully said, that can cause a bit of a pain point when you're trying to figure out how, if as a home buyer trying to buy a property, you want to make sure that you have value within the property you're buying. And for a mortgage broker, I've had some pains trying to order appraisal sometimes. Either the appraisal doesn't respond in time, they're not timely, or they quote me a price I give my customer, and my customer comes back and say, and the appraisal value or the cost to order the appraisal has changed. And so streamlining the process is really critical just to make it easy for everybody. Buying a home is stressful enough. We don't need to add to it.
Yeah, I can totally feel for you being in the mortgage space. I used to be a mortgage broker. I did it for almost 20 years and very successfully. My wife runs that business now. And my biggest pain point was dealing with appraisal management companies specifically because they changed the price on a quarter of my appraisal orders. And I mean, I know you can imagine, but like just imagine 1 in 4 times you're either having to deal with a change in price and have to call a customer and ask them, how they feel about it. Well, tell them that it's more, and it takes everything to keep that client, or you just simply eat the cost difference. And if you'd have just said it was $500 in the beginning instead of $350, and then it goes up to $500, it would have been easier. The customer would have been happy, not being able to die. But I know you wanted to talk about a few things like the factors that shape a home's value, and I think some of the different approaches to appraisals, like appraising.
Correct.
Did you want to start with like maybe the factors?
Well,
where did you start?
Let's start with the factors that shape a home's value, right? As a home buyer, I'm looking at a property that I want to buy. From an investor standpoint, we can talk about from the lender's perspective in a little bit, but from a home buyer's perspective, I'm looking at a property. What are those factors that I should consider to help me make an informed decision?
Well, the first one and the most important, and everybody on this call will probably know it: location, location, location. Right? So.
Yes.
The location plays a huge role in that. So you can take it out to like a more macro level and say, yeah, like look at Toronto. The average sale price in Toronto is 1.1 million, thereabouts. The average sale price in Guelph, Ontario is around 920,000 today. The average sale price in, let's go Swift Current, something like that. It might be more like 280,000. So you can see location must play a factor in here because there's supply and demand issues,
Right.
the more population, et cetera. So that's one. And then within a city, you've got location factors, right? There are certain neighborhoods that are more desirable. There are locations like proximity to the airport, proximity to train tracks, to a laundromat, to grocery stores and shopping. Like, yeah. The funny thing is there's positive and negative locational factors. So as a buyer, you might get a really good deal if you're an investor on a property where I'll call it your return on investment, the rent versus what you invest into the property, might be a really good ratio there. You might be getting lots of rent compared to what the value of that property is. You just got to remember, you may not get the same capital appreciation as a different property. So when you're buying investment property, I think one of your criteria is what's the return annually? And then what am I looking for? Am I looking just for appreciation or am I looking for income? So the location will play a factor in that. Like Brantford has a much better yield than Guelph does,
Yes.
for example. So just things to keep in mind. So location is a big one.
I think you hit it right on the spot. There's the macro location, Toronto, Guelph, Windsor, and all these places. But even within those specific locations, depending on the pocket you're buying the house, also further determines the value. And just because the value in Toronto, for instance, for a townhouse may be 800,000, doesn't mean that all the properties in Toronto, townhouses, will be 800,000. Depending on the location, depending on the schools, depending on the things you mentioned, like gas station, laundromat, all those things also influence the micro value within those small locations. And so
Yeah.
I think going back to your point on, as an investor, it is possible that sometimes you find a property that you can probably generate a lot of annual yield on that because of the rent that you can collect, let's say downtown Toronto or specific locations that are high traffic. However, that property in the back end may or may not yield you the capital appreciation you want on the property. So, and we can talk about that a little more as to what are the things in a specific property that will help you, in addition to possibly generating more income on an annual basis, but also in the back end, what are the things that will appreciate more? We can talk about that. But what are you mentioned a few other things in terms of factors that influence a home's value.
Yeah. When we were talking earlier, I mentioned a few other things. So one of them was, another one is just like curb appeal, right? So, and that kind of speaks to the neighborhood as well. So if you pull up to a house and there's garbage all over the front yard, or it's really well kept, like it just looks beautiful, that does impact the value. And I can't say that it impacts it like 10% of the value or 20% of the value, but certainly when an appraiser pulls up to a property or a potential buyer pulls up to a property, if they look at 4 of them and one of them looks great from the street and the other ones look terrible, then you know which one they're going in with a higher price in mind from the get-go. So appraisers, they do look at curb appeal. I mean, they're looking at everything here. So we got to just remember, when an appraiser does a job, they don't just look at one factor, they look at all the factors. The other thing that I find that really plays a part in this are the upgrades, quality of the upgrades. Are there built-in appliances? What's the quality of the appliances? So really, it comes down to quality of the materials used in the property. So I'll give an example of that. A simple one, doors. You can have solid wood doors, like maple doors, or you can have those hollow doors.
Mm-hmm.
That just speaks to quality. You can buy the cheap MDF, the baseboards along the floors. All the trim can be MDF stuff, or it can be like dark walnut trim everywhere. Like this house, for example, I'm in my home office. Just the trim in this place would probably cost $100,000 to replace.
Wow.
Because like it's dark walnut. It's walnut, solid, right? The doors, I'll show you, Garrett, give you a quick look. Like that's a door that's 150 years old and it's solid walnut. So the quality of the materials in the house plays a big part in it too. Mm-hmm. Of course, the other two main things, the age and the design of the property. So older properties, if they haven't been well cared for, they are definitely going to be worth less than, like there'll be more depreciation on that when the appraiser does their job. The design of the property, people tend to like open concept right now. Sean?
That's right. Yep. The bigger homes.
You get to an older house where there's, all these separate little rooms. People feel claustrophobic. So that doesn't appraise quite as well as, say, something that's been updated and has open spaces and big doorways. And then, of course, there's the size of the property, both the land and the actual building, the number of bedrooms, the number of bathrooms, and is it functional? And that goes back to those small bedrooms, small rooms everywhere, or is there a bit of an open concept and is it a little more functional? So they look at all of this. And I will tell you, 85% of what 80 or so percent of what can be appraised can be done without even going to the house. But 20% of the value comes in when the appraiser gets through the property, walking around it, and they can see, has it been maintained? What is the floor plan like? What is the quality of the workmanship or the materials inside? How many bedrooms are there actually? That kind of stuff. Yeah, so it's pretty amazing. Like some people think an appraiser just kind of walks in and out. Their job is a 10-minute in and out of the property, but they're actually scribbling lots of notes on that notepad that they then reference when they build the report.
I would even add something like little things that a homeowner, you've lived in a home for a while, you kind of ignore because you're used to it. From the perspective of someone who is selling a home, things that they should pay attention to, or even that may seem insignificant, it's like chips on the door or chips on the baseboards, right? A little fresh coat of paint. Even when the appraiser goes into the house, is it cluttered? Because when it's cluttered and there's a lot of things in the way, the appraiser sometimes may, even though the house may be very solid, if they can't see or get their way into the house and to actually see some of the aesthetics of the house, that could affect the value, don't you think?
Well, I believe that the appraisers will tell you, and I think there's a large amount of truth with this, what I'm going to say. Their job is to look beyond the clutter. Their job is to look at property. However, I can't help but think that there's a little bit of, personal, maybe it's bias is probably the wrong word, but influence that hits them. They walk into a property that's not well cared for. They walk in where there's junk all over the counters, right? Like there's just when there's no pride of ownership at all, then you have to think that there'd be some influence. Now, the flip side of it is, hey, if the property's filthy and they know that the homeowner is going to have to invest time and money to bring it back to average, we'll say, for the neighborhood, then they're going to take that into account. Absolutely.
They make the notes.
Absolutely. Like funny, I've seen a lot of appraisals in my time, and the ones that have beer bottles and junk laying around them, they seem to always appraise for less than people thought it was going to appraise for. And the ones that are beautiful, really well maintained, all the rest of it, they have a higher likelihood of appraising out at what everybody thought they were going to appraise at.
So for someone who's selling a home, an investor who's owned this home, or even just a regular homeowner looking to upgrade to another property, I want to sell the current one. You talked about upgrades. What are the most significant upgrades that add more value to the property, would you say?
Oh, well, I think it's a well-known fact. Investing in bathrooms and kitchen give you the best return on your investment. It doesn't mean you're going to get every nickel back out, but often the trade is closer to 1-to-1. Okay. But if you want to get the house sold quickly, you certainly, like the lady of the house, even guys, like they love having a nice bathroom and a nice kitchen to work in. After that, like I would just suggest there's nothing easier than just washing your baseboards and around the door handles, where people grab the door when their hands are dirty, or kids have their hands on the bottom of window frames, things like that. You'd be amazed what you can do with one of those sponges that like clean everything down, clean the paint,
like
get
magic eraser or something to just wipe down the dirt around the knobs, on the door trim, on the baseboards.
Yeah, and that doesn't cost you anything if you're doing it yourself, other than time.
Right.
And it's fairly inexpensive to hire somebody, maybe for $1,000 to come and clean your whole house top to bottom and make it look fresh.
Uh-huh.
So that's a really good return on investment as well. The things that don't give you any kind of return, really, a new roof, a new furnace, upgrading the plumbing. Like everybody buys the house assuming that the plumbing works. It's got a furnace and an AC unit that works, that the roof holds water away, So I wouldn't expect to get anything extra for any of those things, or very, very low return on investment. But fixing a roof that's shot will help you sell your house
faster too.
If you're
right?
Yeah, sell.
So talking about those upgrades and the things that make sense, that increases the value or not, how does an appraiser, this is the other part of that I wanted to talk about, how do they estimate the value of the property? What factors go into estimating the valuation process?
There are 3 methods an appraiser uses, and then there's the automated valuation tools that are available. So for example, if your customers are looking to get an idea of what their property is worth, they can go to one of our tools. It's separate.com, SEPR, the number 8.com.
Okay.
And they can throw in an address. Now, that website is for people looking to get separated or divorced. But the point is, they throw in an address, and for $45, they've got a really solid automated appraisal done using algorithms, and it gets handed over to them in seconds. So that could be a good starting point for them to start getting an idea of what is the data in the market saying about what that property is worth. And then there's 3 methods that they use. The direct comparison approach is the one used the most often. And then the other 2 are the cost approach and the income approach. Several lenders will require the appraiser to do the direct comparison approach, or it's also called the DCA, and the cost approach. They'll require those 2. And so what I would suggest, in the reason why it's used the most often, is the direct comparison approach is the most well suited to a single family residential property. In fact, it's often used for homes where it's 1 to 4 units. What happens in the direct comparison approach is an appraiser looks at the subject property. They find between 3 and 6 comparable properties that are, similar in the neighborhood, in the type of home. So they would try to find other bungalows in the neighborhood with a similar room count, similar bedroom count, similar bathroom count. And then what they would do is they would make the comparables, quote unquote, equal to the subject property. So then they would make adjustments, and I'll show you this in an example in a few slides in a few minutes. But that's the direct comparison approach. They find comparable properties, they compare that to the subject, and they triangulate to a value that they then can land on to say, hey, the subject property should be worth this much. The other one, so if you go to the next slide, so that works all fine and well for regular, homes that trade in subdivisions or, they're a regular type of a house. But then you get something like this one that's showing on the screen here, where it almost looks like it was like 3 modular pieces put together. Very unique. You're not going to find too many homes where the master bedroom soars about 20 feet above the rest of the house on and it's cantilevered like this.
Beautiful.
With a pool. Yeah, with an indoor pool. It is stunning. But if you think about it, you're not going to find comparables like that. So the most appropriate way to value that property is based on the cost approach. What the appraiser does in this case is they look at the land, they find vacant property or sales, they come up with a value just for the land, then they figure out the cost to build this property, to replicate it, and there's a certain amount of depreciation, and this is where there's a little bit of artistry that comes into the appraisal game. Like as much as it's a quantitative exercise, there is some, I'll call it qualitative things or artistry that goes into figuring out depreciation. So in this case, this property here, you can tell by the pictures, it's like new, right? So there'd be very, very little depreciation. So they'd add up the value of the building, the value of the land to come up with the appraised value. So the last one is the income approach. And this is, in my humble opinion, an income approach is best suited to multi-unit residential properties of 5 units or more, where effectively the appraiser looks at what's the net income on this property, what is the going market return on investment that's required for such a property, and then they use those 2 factors to compute a value. There's more to it than that, and I'll explain that later, because I can actually give you some real life applications for how each one of these things is done. Would you like that?
Yes, let's talk about the direct comparison approach, because I think that's the one most people are familiar with. We're going to talk about the rest in a few minutes as well. But understanding how they compare the different properties. And one of the things that, before you go into, one of the things that I've noticed some of my clients say is, well, this property is listed for $700,000. Why is mine only appraised for $600,000? And I always tell them, anybody can list a property for anything they want. That doesn't determine the value. It's properties that have sold recently in that neighborhood that they look at as a way of comparing the prices. And then the other things you're going to talk about, like the rooms and the square footage and appliances and whatnot. But I'll let you talk about that.
Yeah, that's exactly, I love the fact that you brought up how somebody can list for whatever they want. It doesn't mean that's what it sells for. It could sell for more. It could sell for less. Point is, those things don't always line up with each other, right? The listing price and the appraised price. So remember how I talked about location, materials, like age and condition, the size of the building. So an appraiser's job, first and foremost, is to provide an accurate valuation of the property. And so what they do is they search out, as I mentioned, those comparable properties in the neighborhood that best line up with the one that they're appraising. So in this case, I'm showing how the location, in this case, it's called Eastdale in Oshawa, is the comps are similar. And this is not a real appraisal. This is just an example of one. But the point is there is all the properties that are listed here are in the same neighborhood or very, very close to that neighborhood. And so as a result, there is no adjustment for the location. The appraiser's not saying, okay, well, this is in a different neighborhood and that neighborhood is, maybe gets
more
average,
expensive
price per square foot. Yeah, they don't need to make an adjustment for location. For the size of the lot, so the land is worth money. And so there's adjustments that get made based on the difference in the lot sizes. It could be based on square footage. It could just be based on the frontage. So in this case, the appraiser has said, I'm making the adjustment based on the frontage, not the total square footage. The total
lot size. Right.
Yeah. And so they brought the comparables down in value, all three of them, to line up with the subject property. So they're lowering them to be equal to the smaller size of the subject property. So the point here is that they will make adjustments up and down in the comparable properties, and then they provide an analysis. And this analysis is a write-up that explains why they have landed on the final value, in this case, about $875,000, where they had two comparables at $904, one at $815. They're saying, hey, obviously the subject property needs to be closer to the top end of the range. In this case, I would even suggest that the appraiser may have been able to actually stretch and go higher. They may have been able to justify $900,000 because they had two comps that totally lined up. The only thing is there is that third comparable, and if the sale date on that lower one was more recent, then that tells you that the market may be shifting.
Maybe shift in a different direction.
That's right, and that's why they may have gone lower. So that's kind of a bit of an example or walkthrough of the way they marry up both things, which is the direct comparison approach with all those factors, the location, the quality of the materials, how many bedrooms, all of that combined to provide a value.
The cost approach, like you said, is more for very unique properties. So if the homeowner is buying those kind of properties, how do you make sure you're getting a good bang for your buck? How do you make sure that in 5 years, 10 years, what are the things that a home buyer needs to keep in mind? Because for that kind of unique property, the cost approach is most likely going to be used. Or is that the only situation where the cost approach is used, I guess, is my other question.
Well, they also do it like if you're building a house, if you're building an investable property, then there'll also be the cost approach included. Right. Especially if you're doing like managing a construction project yourself as the investor, where you may need several draws to get the property completed.
Right.
But effectively what happens is an appraiser will merge kind of the direct comparison approach with the cost approach, in the sense that they will look around for sales of land, right? So they'll find land that's similar to the parcel that's being sold. They will do a comparison. They'll find, essentially they'll triangulate to find a value for that land. And then they'll do the research around, well, what's it cost to build this type of property? What's the cost per square foot? And they do the research. They'll check in with builders, contractors, etc. And then they'll supply the cost per square foot. They'll multiply it essentially by the square footage of the property being built. They'll combine the two and land on that, the value. And what's interesting is those two things doesn't always line up with the direct comparison approach. Sometimes it's more, sometimes it's less. And in the case where you're buying a house that's already built, it's all really the market forces are what drives the value, right? The market value. So that's why the appraisers rely most heavily on the direct comparison approach. For something where you're building brand new, they have to use the cost approach. There's really no other way, because the rest of it is hypothetical, because you don't have a building yet to appraise.
So for instance,
the appraisal actually happens before the building is built on the cost approach.
So when sometimes, for instance, you buy a new build and it's almost complete, it's a new subdivision, they're earning a lot of comparisons you could make. And in an older town, for instance, most of the homes there are older, but this new subdivision is coming up with brand new homes. How do you use, I guess you'd be using a combination of the direct approach, comparison approach, and the cost approach, because you may not be able to find those kinds of houses in that neighborhood as a whole because it's an older neighborhood. But then there's also the cost of building the house. So how does an appraiser kind of determine what the final value of a new build in that instance?
Well, believe it or not, I mean, like in Toronto, for example, there's a lot of teardowns that happen. And really what people are buying is the land, right?
Yeah.
So that's how the appraisers they find that. By the way, I just want to correct what I said earlier. The cost approach is not only used for brand new, but often it's relied on as the valuation method that's the most accurate when you're building from scratch.
From scratch. Got it.
Okay. So anyway, to your question, yeah, like you're tearing a house down, you're going to build a new one. Well, the value of the land is essentially the cost to buy that property and tear it down, right?
Right.
So they get that information. It's out there. And then that's when as I suggested, they contact contractors, builders, they get the average cost per square foot. And there's other programs that they can buy and tap into that provide similar information. So then it's effectively, it's math, right? They're multiplying the cost per square foot or the main and the second floor, for example, against that cost. And then they'll do the same thing because the basements are less. They'll multiply the cost per square foot for the basement versus the actual square footage. And they add everything up and there's the value. Bottom line, like it's that straightforward. Now it's a lot of work, believe it or not, because there's a lot of research to find out cost per square footage. It changes. Imagine trying to figure that out during COVID.
With the value, with supplies and the supply chain being backed up and the cost of goods skyrocketing, like lumber, for instance, was extremely expensive. Building a fence just building a deck was more expensive. A deck maybe would have increased the value of your property in that little short time because of the cost to build a deck was more. But
yeah, crazy. I saw a funny meme where it was like some guy pulling a trailer of lumber down the road, and it said, "Look, I'm a millionaire." I thought that was pretty cute. Anyway, there is one more approach I wouldn't mind just giving your listeners just some understanding of, and that's that income approach. And so for the income approach to value, what an appraiser normally does. So this is for an income producing property. So generally 5 units or more, or it's like a strip plaza, something like that, right? It's all about the income. You're buying the investment to get money back, a revenue stream. What the appraisers do is they look at sales of similar properties and they figure out, and normally what's included in that is the net income and they find out what the final sale price was. And that can tell them what the capitalization rate is or the return on investment required by investors for that kind of property. So for example, if a strip plaza sold for 10 million and the net income was 1 million, that means the return was 10%. It's 10%
Just 10%.
a year. Exactly. So if they do the analysis on 5 properties, 6 properties, and they see that the income approach or that market analysis says that the expected rate of return should be 10%, then that is the capitalization rate that they use for the math on figuring out what the subject property is worth. Then they effectively they validate all the income and expenses for the subject property to come up with the net income. And let's just say it's $50,000. Well, then they're dividing by 10% to come up with the value. And in this case, the value would be $500,000.
Interesting.
Yeah, $500,000. That's right. Now, that's a really, if it had been 500,000, not 50, then it's worth $5 million. Right. That because like maybe it's a smaller strip plaza, couldn't find anything that's comparable. But that gives you an idea. Like they figure out, okay, here's the comps, here's the range of the return on investment that's required. Might be 8 to 10. They may land on some number in between the two. And then they apply that against the net income for the subject property. So this is most useful for multi-unit residential properties and for strip plazas because the numbers are known. There's tax returns, there's, financial statements that prove stuff. That's why it's less relied on for a 3-unit, like a 3-plex or 4-plex.
That's right.
Because like there are things like the homeowners might write off some of the office expense or, gas and this and that, the other thing related, from driving to the income property or whatever. That's why they often will rely on the direct comparison approach for a 1 to 4 unit rental.
I think it's definitely good information for home buyers. If you're buying a rental unit with just a couple of units in there, then be mindful that the direct comparison approach would be used. And sometimes if it's a new build, then there may be a bit of the cost approach as well. But if you're buying a multi-residence over 5-unit property, then you're looking at the income approach to try and figure out what the proper valuation is. I think this is key information for home buyers to know so that you go into the home buying process informed. Chris, this has been very informative. I don't want to cut you off. You wanted to add something?
Well, just one interesting thing. So for your investors, if they buy an income producing property, they need to keep in mind that the final value of it really relies on that cap rate, that rate of return.
Right.
So just think about what happened to values on income properties from 2 years ago to today. You can get a multi-unit residential mortgage at 1.5% 2 years ago and finance that for 25 years. All right. Today, the rates are more like 4%. It would be an interesting exercise for your investors to take $100,000 and divide it by 1.3% or 1.5%, or take that same number and divide it by 3%. You'll see that the value is cut in half if you go from 1.5 to 3.
Yeah, because
so that what's interesting is that can happen. The benefit is on these types of mortgages, you can often get them for 20 years. So you're not going to be
refinancing in 5 years.
Yeah. And so just for your investors out there, if they're going to take a buy and hold approach, it's not a bad idea if you can get a good rate at 10% and a good rate for 10 years, locking it in for a long time if the rates are good.
Right.
Because it protects you in the event that rates rise, because you very quickly go outside on your payments between your rent
and your expenses.
And
your
mortgage
income.
Yeah. So just keep that in mind. Like if it's great if your tenant moves and you can jack the rent up, but if they're long-term and you can't, you can be underwater for a while. So just, caution about that. Long-term people tend to win when they invest in real estate, but this is an example of a time where people can get offside.
Right.
Now, I do think the rates have gone up enough though now that should be less of a concern, that there's a lot more upside potential because rates will probably come down in the next year, but that's your wheelhouse, right?
Yeah. Right now, if you were buying a property and you get really good value for it, those numbers you have, if you're buying a house right now, I probably wouldn't even lock in for more than like 3 years because rates are going to come down. But if it's a good buy from a valuation standpoint, this is a good time to buy because what that means is that rents are going to go up, but rates are going to come down. And so your rate of return is actually going to increase over time. So you're going to maybe lock in for 3 years here we're talking about the multi-unit property, 5 more properties. Lock in for maybe 3 to 5 years. But keep in mind that rates will likely come down at some point, not in the next 6 months, as most people are expecting, or probably closer to a year and a half from now. I'm estimating late 2024, early 2025 before rates start to fall. But anything can happen. Nobody has a crystal ball.
One more thing I wanted to share, and maybe we can talk more about this at a future podcast, but one of the things, like a strategy, you asked me, well, what are some of the strategies to leverage an appraisal when I'm buying an investment property? And one of the things you can do, or your investors can do, is they can get an appraisal done on a property up front before they do the deal, before they negotiate the price. And the reason for that is they know what it's going to appraise for. Like they have the number from the appraiser. And if they negotiate a deal where the price is less than that, well, now they're already in the money.
Right.
You're already ahead. But if the seller, won't come anywhere close to what that appraised value is, then you can simply walk away, chalk up the expense as, it was a good investment.
Right.
And I just think that there's an opportunity there to, learn, come in well prepared, because the best negotiators are the ones that are the most prepared.
They have their numbers. They know exactly what the value is, and they know how to negotiate with the seller. So you're saying in a situation like that, get the appraisal first before you even put in an offer, an official offer, and then use that as a negotiating leverage to be able to get a good purchase price. Because if he comes in at $500,000 and you already see what the property has, you can maybe try and come a little under that so that you have some locked in value in that property.
Exactly. Yep. Yeah. Nothing better than buying it on sale.
Absolutely. Absolutely. Chris, this has been really great. Thank you so much. I even learned a lot, and I learned a lot more today than on appraisals. It's a part of my work, but this has been very informative for me. Before we wrap up, if homeowners want to find you, if anyone listening to this podcast wants to find you, what are your contacts, your website and information, social media handle, or anything of that sort?
Oh my gosh, social media handle. I'm over 50, man. You can find me in Facebook or LinkedIn just by searching my name, Christopher Bisson, Bisson. My email address is chris@valueconnect.ca. And I've got a team here. Like this is a company, so we have a whole team. We have a customer success team. So if you need to inquire about an appraisal, info@valueconnect.ca, and one of our amazing customer success team members will take great care of you. But thank you, Sean, for having me. This has been great.
Thank you very much for coming. We're going to have you back because we want to talk about market trends. We didn't get to talk about that today, where the market is, where you think the market's going. We will have you on the show once again. But thank you very much for joining us. You've been listening to the True Wealth Podcast. See you next time.
This is all the time we have for today. Thanks for listening to the True Wealth Podcast. Don't forget to rate, share, and subscribe to the True Wealth Podcast on your favorite podcast platform. Follow us on Instagram, Twitter, or Facebook @True Wealth Pod. We'd love to hear from you. Share your thoughts, ideas, and questions with us on our social media platforms, or email us at podcast@truewealthadvisors.ca. And who knows, your question might be the subject of a future episode.